Hi, I am Joe Halpern, Chief Investment Officer of Fountainhead. Welcome to Investment Wars. At Fountainhead, we regularly incorporate debate into our analytical process. On this podcast, we seek to have meaningful, respectful conversations on major themes within the economy and markets. Will globalization end? Will China pass the US in overall GDP? Will robots take over the world? This is our effort to better understand the nuance and complexities of financial markets. Today's episode is on trade imbalances, CapEx booms, and the next industrial frontier. We have with us today Eli Horton, who is a senior portfolio manager at TCW. He leads three of the firm's active equity strategies: PWRD, powered, I assume, transformed systems, which invests in the energy transition; SUPP, transformed supply chain, which invests in reshoring of supply chains and manufacturing; and TCW Compounders, GRW, which invests in very high quality defensive growth companies. This is actually the first episode where we have a guest in person, so I'm pretty excited about it, beyond just a great conversation. So Eli, thank you very much for coming in today.
Good to be here.
So I want to kind of open it up with just the macro statement on trade imbalances. We have a perpetual trade imbalance here in the U.S. that is close to $1 trillion. It's close to 3% of our GDP. And what that means is that every year, roughly $1 trillion leaves the United States. It goes international. Could you help unpack and really explain that should on the surface be very clearly problematic, right? It adds to our debt levels. It creates all sorts of issues. Could you help kind of unpack that a little bit more in terms of how it impacts domestic production capacity and some strategic elements?
Yeah, absolutely. It's sort of interesting if you think about it in a historical context too. I think the word imbalance is obviously very strong, although I think that naturally some imbalances in trade should exist. Comparative advantages are a real thing in the world. Some countries are better at producing, widgets or bicycles or whatever it may be. We have our own relative strengths. Those are actually on the service side, as you know. And so we've run a trade deficit for, I believe, about 50 years, but it's really exploded over the past 10 to 15 years since the GFC. As you noted, it's about $1 trillion today, which is quite significant. And it raises a number of questions and problems in our economic system. You have the obvious, which is the industrial manufacturing base and the industrial and engineering talent inside the country. That's obviously been hollowed out to some extent, which is a major issue. We have rising concerns over security as well. Security of whether it's critical minerals or technological innovations like semiconductors and IP. And now we also have concerns over how do you fund this deficit. You send $1 trillion out of the country each year. We spend $1 trillion more than we sell. That has to be funded through raising more debt, through foreign investment. That raises questions as well. And so those are sort of the framework of the three things that I would use to think about this.
That's great. Thanks for that. I want to go towards you kind of mentioned hollowing out of industrialization. And, let's start there. This feels bilateral. The politicians kind of agree, in my view, Democrats and Republicans, they just disagree in the method of getting there. So if you think about the Biden administration had the CHIPS Act and a whole bunch of acts to try to bring manufacturing back. This administration is using tariffs as an approach to essentially get, and also maybe strong-arming some people to bring manufacturing to America. So let's start with, I'll title it CapEx and the Capital Rebuild. How do we bring back, or what do you see from your seat in terms of infrastructure build, semiconductor building out, manufacturing, and so on?
There's so much in there. You're exactly right. It's bipartisan. I think across the aisle, it's recognized that the industrial economy and the industrial footprint and architecture of this country has been hollowed out, and that poses problems. The COVID-19 pandemic was really opened up our eyes to this. It was somewhat of an X-ray, if you will, that shone a light on how fragile the system is, and you can't build resiliency through exporting. And we now have multiple administrations. It really started with the first Trump administration, focused on providing policies or implementing tariffs and using a variety of tools to support domestic manufacturing. There are many ways to approach this. Tariffs are really a target at the more of the symptom rather than the underlying root cause, I would say. They're only one tool that we have. We should be thinking about public partnerships. We should be thinking about programs like the CHIPS Act or even the Inflation Reduction Act, which has now been partially repealed, and a variety of ways to address this problem. We're seeing a number of these initiatives being attempted. What that means to us is that we're entering not a CapEx cycle, but CapEx decade or decades as part of the U.S. industrial renaissance.
So that's a real opportunity, a CapEx. If you think about it, you build, whether it's through the CHIPS Act, however you do it, you're building something here, which means there's productivity, there's all this growth going on, and then you're putting people to work. So let's start with the first one in terms of where do you see the CapEx going? How is the CapEx being spent, both publicly and privately?
Take the CHIPS Act. So this is the perfect example of the U.S. semiconductor industry. So if you go back about 40, 50 years, we produced most of the world's semiconductor chips. What happened? Companies realized that there was a labor cost arbitrage of producing internationally. So first Japan took some market share, then Taiwan with TSMC, South Korea, Samsung. That was for two reasons. One, the labor cost arbitrage opportunity, but then U.S. businesses said, we can become capital light, fabless, and just design the chips, and manufacturing moves overseas. The problem with that is not only did we lose manufacturing, we lost the whole ecosystem. We lost engineering talent. We lost the materials component of this. We lost the semiconductor equipment manufacturing side, the assembly. And so the whole industry left, and we've gone from a majority market share in semiconductor chips to now something like 10%. That's a huge problem, but it's a perfect example of how one aspect, just labor cost arbitrage, ends up destroying or hollowing out, maybe is a better way to say it, the whole system. So what are we seeing? We're seeing the CHIPS Act, which was a very meaningful incentive program that was a catalyst for Taiwan Semiconductor to build a couple of fabs in Arizona, Samsung building fabs in Texas, and a number, Micron, others, Intel, all deploying capital behind state-of-the-art and ideally leading-edge manufacturing in the U.S. The problem is, for us to be efficient at the leading edge will take a very, very long time. But we're seeing hundreds of billions of dollars of capital focused on this, in part due to the CHIPS Act and support across the aisle from the administrations that we've had over the past, two tenures.
So sticking with chips in a minute for a moment, and it's interesting. I'll do a call out for Chip Wars, which is an amazing book, just going over the history of semiconductors. A fantastic read. There are some chips, like the most advanced NVIDIA chip, which is being used in AI. And then there are other chips, or I'll call them semiconductors, which are used in a $2 toy that my kid may have at home. So it feels like, and I want to go here in that we can't bring all manufacturing back to the U.S., but it feels like we want to kind of bring perhaps strategic manufacturing. Like, could you help kind of like get that bold line under semiconductors of like, what do we actually want to bring back versus what are we fine with where?
I think we need to bring back just the broad-based capabilities to support our economy almost in terms of a security perspective. I mean, if China were to invade Taiwan and TSMC were cut off, I've seen estimates that that's immediately a 10% hit to GDP in the U.S. Staggering. That's a massive recession. And how do you rebuild from that? We don't even have the critical minerals readily available in the U.S. to then go into that supply chain. So there's these vulnerabilities and gaps that we need industrial policy and public-private partnerships to support. Now, we'll probably get into it, but this creates a litany of investment opportunities of the companies who are sort of a layer deeper than the semiconductor industry, the picks and shovels that are supplying to those industries. But really, our objective is very focused on security and resiliency and what's the baseline level of capabilities that we need to have to accomplish those objectives.
Yeah, let's get into it right now. So, like, you know, if you think about it, so we're bringing CHIPS Act. We continue in this administration in bringing back these chips. There's two purposes. I agree with your sentiment in terms of purpose number one, strategic. It's becoming, and maybe we'll touch on it if we have time today, an increasingly scary world geopolitically. And so for America to really hold on to its global dominance, which I want as an American citizen, you have to have the wherewithal to be able to build everything for us to have appropriate sufficiency, I'll call it. So that's the strategic side, and then the other side is obviously building out capabilities, maybe just to ensure jobs, etc. Perhaps. So go down that level, or go down to, okay, what is the opportunity? We agree we need to start building things out, and we actually are and have been for the last few years, which is great. What does that look like right now? Are these factories actually done and completed in Arizona and the Southwest and everywhere? And what's going on there? And like, what are the picks and shovels?
I said it earlier. It's not just a CapEx cycle. It's a CapEx decade. I think more than a decade, and it sits in contrast to sort of where we came from the past 15, 20 years, where CapEx to sales ratios in the U.S. have been near multi-decade lows, as companies have focused on asset-light digital endeavors, as buybacks have been favored. And so we've had this sort of chronic underinvestment in infrastructure, in the manufacturing base, just as manufacturing has left the country. And now we're left with this dilapidated base that also is facing a material reinvestment and growth investment need. So it's really, you could almost call this like a copper, concrete, and code type of opportunity. Code meaning, continued AI investment, but copper and concrete, we are rebuilding infrastructure in this country and adding to the infrastructure base. Factories like TSMC, they're still in construction. Some are up and running, but the large majority of this is still on the come. And think about what it means for construction materials, like I said, concrete, copper, some of the automation that goes inside of these factories, building systems like HVAC, engineering workforces. Like these are material drivers of these old economy picks and shovels types of industries.
Now, what about, my secondary comment was like making sure we have full employment, but in reality, we've had full employment for a very long time, ignoring what anybody thinks about AI. We are 350 million strong here. We're 5% of the world, less than 5% of the world, 3% of the world. How do we deal with labor if we really start bringing back? You're talking about what feels like so many jobs. Maybe it is automation. I don't know. You tell me. But is there a potential for inflation there? Are there bottlenecks there?
This is inflationary.
Okay.
Yeah, I don't see how you can get around it. It's a reversal of priorities, though, because the past 50 plus years, companies have focused on, and the government has been willing to sit through a focus on cost avoidance at the expense of fragility and lack of resiliency in the supply chain. And we've seen all the problems, right? COVID was the easiest example to point out, but there's been others. Global supply chains were far too complex. You couldn't get a new car during COVID. You couldn't get a washing machine. You get a boat stuck in the Suez Canal, which completely disrupted certain supply chains, which is crazy. So where do we go from here? It is focus on local, not global, and that is going to be inflationary. But it's an expense that we have to bear to drive up resiliency. How do you solve for the labor piece? It's about productivity, most importantly, because there's only so many people to work. How do you drive up productivity? An automation base for sure inside Factory 2.0. and then increased intelligence from the AI layer, I think is a great opportunity inside of manufacturing factories. There's a number of companies that are focused on this intelligence layer as well. So that's the path we have to go.
So inflationary from the standpoint of wage growth, inflationary from the standpoint of goods growth, like terms goods being more expensive, all of the above?
So typically the landed cost of a good that's manufactured in the U.S. versus comparatively manufactured somewhere in Southeast Asia is higher. I talked to a guy who had moved a factory that manufactures mattresses, pretty low IP. It was actually interesting that he brought that back to the U.S. So they were manufactured in China. He brought it to a factory in the Midwest, and he said his landed cost was 10% higher. Most of that was labor. Now, he made the argument to me, which I thought was compelling, that he could get that 10% lower over time. He thought he could bring it down to parity within 5 years. And my question was, is that through automation? And he said only partially. He said some of it is just having product design down the street from the factory. His engineers can walk into this factory and look for ways to optimize in ways that they wouldn't have had access had that factory been overseas. And so it was things like, hey, you're bringing in this foam and the steel coil in these certain ways to make the mattress. If you did it over here and if you moved it over there, that would save you 1% yield and certain time efficiencies. He thought things like that would actually bring him down to parity. But to answer your question, it's just more expensive. Whether it's largely labor is the biggest answer.
Got you.
Now we'll see this outside the U.S. in certain places like Europe, where they have an energy security issue that is also inflationary for them. But we're very fortunate where we have abundant, readily available energy in this country. We're very energy secure, so that shouldn't be as much of a problem.
So but with inflation though, because we have this, call it decade of CapEx and building out, bringing things back in, hiring people, there also should be growth. Are you bullish on growth? Do you believe that we'll have increased growth, especially, right? You bring things back, and then also if you get any of those AI layers or anything, you have increased productivity and growth. And the reason I'm bringing it up is just everybody who's old enough, which is older than me, thankfully, at this point, remember stagflation, right? And stagflation was, so I think that's the big fear. The last time the inflation goblin came, it came with a really bad economy. But growth solves that somewhat. So what's your views on that?
I am optimistic. Look, the country has a history of innovation, of creativity, of entrepreneurship, and of policies that support it. Where I worry is maybe on the policy side, and are we getting our own way? We're overly regulated. We currently are really struggling to find a direction with where we're going on, call it industrial policy, because that's really what these tariffs are attempting to pursue. But I'm bullish. These are issues that are really quite mandatory for us to solve. They require large investment. That investment should create growth for businesses. It should create jobs. Manufacturing jobs are quite good too. 5x multiplier is what one manufacturing typically creates for incremental jobs inside of a community. As one manufacturing job has supplier jobs that it creates, has downstream jobs inside the service community. So these are good for local economies. We've seen examples of this. First Solar put a plant in the Midwest, and it literally took out 1% of unemployment in that MSA. That was very powerful for those communities.
So now I think it was maybe 1 or 2 episodes ago, we had someone who spoke about energy infrastructure. You manage Powered, PWRD, which is infrastructure, power, and modernization, I guess, around energy. Is that correct?
Correct.
And so you think, so first of all, just as a stat, my understanding is that energy usage in this country has been basically flat for the last 2 decades, probably a result of efficiencies within energy, which I imagine will continue. But now there's 2 items happening. One that everybody talks about, which is AI is a power suck. It just uses tons of power to do what hopefully a way, way better job than Google does in search, but all these other great benefits for us. And then the second one that you're highlighting, which is CapEx, which I imagine also needs energy. Could you speak a little bit to what needs to be done there, benefits, detriments, what you see coming
The
out
energy
of?
transition is so broad and it's so massive, and it'll take decades to solve it. But we're trying to get to something close to 100% renewable state. From today we are 15 to 20% renewables. If you look at where energy comes from, that creates a number of opportunities in a variety of systems, and one of them is the grid, like you mentioned. And the grid of today is not sufficient to solve what we're building and where we're going. I 100% agree. 2 decades, electricity demand's been flat, and that started to change a couple of years ago. I think there's 3 reasons why. You mentioned the CapEx piece, which is, let's call that sort of reindustrialization and remanufacturing. The other one that I would throw in there is electrification of everything. So think electrification of vehicles and of our entire economy. Those 2 pieces on their own, I think, are enough to drive 2 to 3% electricity growth per year, and we've actually seen that. And then more recently, AI came in and just poured gasoline all over this fire, and has completely flipped the equation on its head and created pretty material bottlenecks that I think are getting worse in power generation. So this is perhaps one of the more tangible examples that you can come up with, which highlight how different the past and the future will be. And it's creating stark bottlenecks and problems. And usually where there's bottlenecks and problems, there's pretty meaningful investment opportunity.
Okay, and you mentioned renewables, and so that opportunity is in building out infrastructure, essentially? Is that most of it?
Well, think about it. So 2 to 3% growth in electricity doesn't sound like a lot. Do that for 30 years, and it's a doubling, right? So take the grid of today, and then by 2050-ish, that grid needs to double. It's worse than that because we're adding a material amount of renewables, mostly solar, some wind, which are intermittent. You can't use it 24/7. And so you need to have excess capacity of that renewable power generation. So a doubling of demand could lead to as much as a tripling of supply, i.e. the grid needs to triple in size. What is the grid made of? It's made of a ton of metal components, copper, steel, some aluminum, a bunch of transformers and switchgear and physical goods. Take high voltage transformers. There's only 3 companies in the world that make those.
Are they here?
And they're sold out. What's that?
Are they here?
One of them is, at least. One of them is. They're sold out for 5 years, 4 years. Take a lot of price. We're looking for those kinds of opportunities, but this is a physical good, a CapEx revolution, if you will, to solve a problem that's driven by structural needs, electrification, bringing manufacturing back. We talked about that, AI.
So we started this episode speaking about trade imbalances and basically said trade imbalances are bad. And just there alone, perpetual trade imbalances are bad. So just there alone, we needed to do something. And then we very quickly pivoted into, well, one of the reasons it's bad is just strategic. We referenced the world is becoming increasingly scary, unfortunately. China feels like a foe at this point. And I'll just bring up one other comment you made, which is we can't and we probably don't want to actually produce everything here. An example we use within our market commentary was just the spice or the bean vanilla. We can't readily grow vanilla. Why would we bother growing vanilla here? So that's something we'd have to import. So this all goes into supply chain, which you said is quite fragile. Speak to us a little bit about where the supply chain is right now. You gave us a little bit before, but just go back into it generally and like where you see or how you see the global supply chain shifting over the next, call it 5-10 years.
We're going to see a shift to, it's a fairly popular term now, but a multipolar world. The policies of past decades built a supply chain mostly in China. And it's not just the US that's focused on this, but even a country like Germany is focused on this, where they've their public investment has been like 2% of GDP, something like that, which is very, very low for a G7 country. And we've seen them announce some pretty material investment in their base. So the U.S. is certainly leading the way, but other countries are following, and we will see more localized supply chains, manufacturing. I don't think there's any way around that. That creates this capital flow opportunity. What I think we should do, though, is just be a little more thoughtful and targeted about what we're trying to move. Like we talked about semiconductors, makes perfect sense. Like it's almost a security imperative to be able to stand on your own 2 feet for technological and semiconductor IP. But things like, I think your example is vanilla or like bananas, we're not going to do that here. So this approach of a broad-based blanket tariff approach maybe isn't the most thoughtful, and instead we should target the certain industries that matter the most. And maybe some of that's through tariffs, but I think there should be public-private partnerships and other thoughtful policy around the manufacturing side, around the knowledge base and educational base inside of high IP and engineering industries. I think we should have a more rounded approach like that.
Yeah, it's really interesting when you think about China. It's not just a bunch of people in a warehouse putting things together. There's true IP there to run these massive manufacturing hubs. My understanding is because I think what's been going on with China has been going on now since the first Trump administration. I think the first administration really highlighted it. It was continued by Biden, and manufacturing's moved to India. My understanding is that the managers there are Chinese because of the IP. So how does it necessarily hopscotch around the world, whether it's Vietnam, like do you see us still trading with Vietnam, or we're going to move everything to Mexico or Central America or somewhere? Like, I don't even know where some of this stuff could go. Like, how does it?
I would imagine it's yes to all of those.
Okay.
I hadn't heard this example, by the way, about the guys in the factory in India, but it doesn't surprise me because I've heard of other companies moving their supply chains and then needing to bring in executives from China to help teach their local teams how to do it. There's an engineering and knowledge know-how that gets lost over time, because if there is no jobs, why would you go study it, or why would you have had multiple generations of people in that industry? It just gets lost, that talent. But I think we need to have diversification if the focus is on resiliency of supply chain and manufacturing. Now, we're in a bit of a food fight with Mexico at the moment, but to me, Mexico represents a huge opportunity for us. It's a huge opportunity for them too, to be the largest import partner of the U.S., to be a critical manufacturing partner. They have widely available talent to do the jobs, and it's cheaper actually to manufacture in Mexico just on a labor basis than it is in China, let alone some of the other concerns around transportation, moving things across the ocean or through the air, or some of the geopolitical and national security concerns. So I remain kind of long-term very optimistic on Mexico.
Okay, and we spoke primarily about chips getting reshored, and that's a huge one. Can you give us some other areas or categories that you believe are going to be reshored, or I'll call it, I think is it called nearshored, homeshored, regional? Yeah. It's all these different names for what you call basically moving manufacturing to Mexico. So either here or there.
Yeah, any of them work. But I think it's anything that's high IP content is what we should think about first. There's been discussion about shipbuilding, for example, and how we don't have that skill, and that can actually matter. Now, we are very good at aircraft manufacturing, or we're okay at it, maybe. You could debate.
Boeing.
Yeah.
Sure.
We at least have one of two companies in the world that does large-scale aircraft manufacturing, so that's an important one. I think absolutely the semiconductor side, there's been a lot of efforts around renewables, specifically solar, where there was a lot of dumping coming in from China, and we've really had a variety of efforts to contain that. And there's only one large-scale utility solar manufacturer in the U.S. today, but that represents an important opportunity. All the various components that go into the grid, having reliable power. Look how much China's adding to their grid each year. Having reliable power is critically important for our country, and there's a variety of components. So you asked me about the large-scale high-voltage transformers. 3 companies make them. we at least have one in the U.S. It'd be nice if there were more than one. Same thing goes for all the components that are going into the grid. So I listed off kind of a variety of things, but I think it's high IP is where we should start.
Got you. Okay. And so let's talk about winners and losers. What do you see over the next 5 to 10 years in the U.S.? Like which industries, what segments are kind of the biggest winners?
I think there's a reemergence, or there's a new leadership that's emerging. And that leadership is companies that are very forgotten. It's old economy businesses. We're already seeing an industrial renaissance take place. We've had almost $2 trillion of new manufacturing announced in the US in the past 4 years. That's 4 or 5 times what we would have typically expected. Why is it so massive? It's all the reasons we're talking about. It's the need to bring manufacturing back. It's the need for security. It's the need for resiliency. And so the types of industries that benefit from this, we love the picks and shovels. Companies providing certain materials or engineering capabilities, companies providing automation systems, building management, HVAC type systems, transportation, railroads, less than truckload carriers that are moving industrial goods around this country. These are businesses that have been starved of capital and reinvestment for decades, and that headwind is shifting to a tailwind. That's where the winners are.
Is that coming, so it's partially coming from government, like the big one is CHIPS Act. I know we had something that worked with infrastructure as well, but are they really putting money into, like, it feels like we're behind in trains, and as you mentioned, like we can't build a boat here.
Yeah.
But is that private public? Is that like?
So it's a combination. So most of the reinvestment actually tends to be private, about 2/3 when we cut the numbers. And the fact that we're behind heightens the need for investment, heightens the opportunity for us.
Okay. And then how about what industries do you believe face the biggest headwinds?
I think you could probably look at certain, we'll call it like low margin importers. So maybe certain consumer type of companies, consumer retail businesses that have relied on a very low cost import base from China. I think over time that becomes increasingly challenging, and those businesses tend to run on lower margins. Yeah, so low margin consumer retail importers.
Yeah, it's really interesting when you think about that low margin business in combination with the rebuild here that's going on in America in terms of CapEx and what's going on with the supply chain. American citizens will still want the cheapest thing possible. Maybe people will look for the built in the USA tag, but I think a lot of people will just look for something that says $1.99 as opposed to $2.29. But what I think I hear you saying is that $1.99 cost will probably be higher because the supply chain will not be as efficient as it's been and maybe be less used. Is that?
I think you nailed it.
I nailed it?
Yeah.
Finally, I got something. Okay, that's cool. Listen, it's exciting. Some of these podcasts aren't necessarily optimistic. This is a pretty optimistic one in terms of where we're going. And if you think about just kind of, I'll call it Wall Street leadership over the last decade, over the last 20 years, it's really been technology. America's been dominant in tech, and we're in a tech war and a tech race right now with AI, which is really a revolutionary item. But it feels like we left a lot on the side while going after tech. And it feels like a lot's kind of coming back. Is that fair?
I think you said it really well. We can't afford not to make this transformation. And technology has had a very strong leadership position for, would you say, 2 decades. And I think there are aspects of, or segments of the technology industry that will continue to be leaders. But those leaders and where the innovation is coming from on the technological side is driving a new class of leadership. Old economy businesses, I would include semiconductors within that, and then a number of the other companies that we've talked about. And so as an investor, when you see these sort of sea change moments where there's a pivot from a prior regime to a new regime, that's just perfect for our process to go in and try to assess what's happening and sift through the carnage and look for the companies that will emerge. It's a ton of change. We can have unique views on that change. So I am very optimistic about not only the prospects of growth, but also just how it sets up for, fertile hunting ground as an investor.
So let's sum it up with, what are you just most excited about over the next 5-10 years?
We've danced all around it, but it's the industrial renaissance or the reindustrialization of the U.S. It's driven by the need to completely overhaul and revamp our energy system, to rebuild the grid, to redevelop, reinvest, rebuild the manufacturing industrial base. That's the opportunity.
Great conversation. Thank you so much for coming on today, Eli.
It was a lot of fun. Thanks.
If you like what we do, rate and review the show on Apple Podcasts or Spotify. Every positive review helps new listeners find the show. Send us the debate topic you are most interested in by emailing us at podcast@fountainheadam.com. Thank you to Fedis Mooney for production, Sarah Mance for marketing, and Dalton Morrow for research. I am your host, Joe Halpern, looking forward to our next investment war.
Fountainhead sponsors the podcast to further education and critical thinking about the factors that affect markets and investing, and the podcast does not provide investment advice. Investment advice is offered only to clients of Fountainhead who have entered into an advisory agreement and with whom Fountainhead has identified individual objectives, risk tolerance, and other investment needs.